In March 2023, central banks around the world did something unprecedented. In just 72 hours, the Federal Reserve, European Central Bank, Bank of England, Bank of Japan, Swiss National Bank, and Bank of Canada issued a coordinated statement that received almost no media coverage. They announced the establishment of standing swap line arrangements, permanent channels to exchange currencies with each other at a moment's notice, with no limits at any time. Think about that. The world's most powerful financial institutions just created an unlimited emergency funding system, and they're calling it precautionary. When was the last time central banks described something as precautionary, then never used it? Never, because they're preparing for something big enough that they needed every major central bank coordinated and ready, something they clearly see coming but won't publicly acknowledge, and the evidence of what they're preparing for is hiding in plain sight. Let me show you what central banks have been doing when they think nobody's watching. First, the buying spree. That doesn't make sense. In 2022 and 2023, central banks around the world purchased 2,262 tons of gold. That's the highest level of gold buying in 55 years. But here's what's strange. They bought this gold while simultaneously claiming inflation was transitory and their currencies were stable. Why buy gold if your currency is fine? The People's Bank of China reported adding 225 tons to their reserves. Poland's central bank increased holdings by 130 tons. Singapore, India, Turkey all loading up on physical gold at record pace. But it gets more interesting. Second, the infrastructure nobody asked for. In July 2023, the Bank for International Settlements, the central bank of central banks, launched something called the FI-N. Not a typo, the FI-Net. Their description: a vision for the future financial system. Buried in the technical documents is this phrase: capable of operating during periods of financial instability or infrastructure disruption. Translation: they're building a backup financial system. Why would you need a backup unless you expect the current system to fail? Third, the rehearsals. Every year since 2020, the Federal Reserve, along with the Treasury and FDIC, has been conducting what they call resolution planning exercises. These are detailed simulations of major bank failures, but not just one or two banks. They're practicing coordinated responses to simultaneous failures across the banking system. The 2023 exercise included this scenario: multiple systemically important institutions experience severe stress following a sudden loss of market confidence. They're not planning for a crisis, they're rehearsing for one. If this feels familiar, it should, because we've seen this exact pattern before. In 1927, the central banks of America, Britain, France, and Germany held a secret meeting at the Federal Reserve Bank of New York. No minutes were published, no press coverage was allowed. What we know from documents that leaked years later: they coordinated a joint policy to lower interest rates simultaneously, despite growing credit bubbles in their respective economies. Why? They were trying to support the British pound, which was struggling after Britain's return to the gold standard. The result? That coordinated easing supercharged the credit boom that led directly to the 1929 crash and the Great Depression. What's significant isn't just that they made the wrong decision, it's that they made it together, in secret, while telling the public everything was fine. Fast forward to March 1968. For months, central banks had been meeting secretly in Basel, Switzerland, the home of the BIS. The topic: defending the gold standard. As dollars flooded into Europe, they created something called the gold pool, a coordinated intervention mechanism where central banks would sell gold together to suppress the price and maintain the fiction that $35 could still buy an ounce of gold. For years, they told the public the system was stable. Meanwhile, they were hemorrhaging gold reserves trying to hold it together. What happened? By August 1971, Nixon closed the gold window anyway. The system they spent years secretly defending collapsed in a weekend, and everyone who trusted the central bank narrative lost purchasing power overnight. Here's the one that should terrify you. In August 2007, central banks first introduced those temporary swap lines, the same mechanism they just made permanent in 2023. Federal Reserve transcripts from that period, released years later, show something chilling. In their private meetings, Fed officials were discussing severe stress in the banking system, liquidity concerns, and potential contagion scenarios. What were they telling the public? On June 20, 2007, Ben Bernanke testified to Congress, We do not expect significant spillovers from the subprime market to the rest of the economy. 4 months later, they were creating emergency lending facilities. 14 months later, Lehman Brothers collapsed and the financial system nearly ended. The pattern is always the same. Coordinate in secret, build emergency infrastructure, tell the public everything is fine, then act shocked when the crisis hits. So what exactly are they preparing for this time? The evidence points to 5 specific scenarios, and they're preparing for all of them simultaneously. The U.S. Treasury market is $26 trillion in size. It's supposed to be the most liquid, stable market in the world, but in March 2020, it broke. For 3 days, Treasury prices went haywire. Normally, the safest asset in the world became untradeable. The Fed had to step in with $1 trillion in purchases to restore function. In October 2023, it happened again. Treasury market liquidity evaporated during a routine auction. The Fed had to quietly intervene again. Now look at what they're building. The standing repo facility expanded to include not just banks, but primary dealers in eligible money market funds. Capacity, unlimited. Availability, 24/7. They're building infrastructure to keep the Treasury market functioning when it breaks again, not if, when. Why would the Treasury market break? Because there are $7.5 trillion in Treasury securities that need to be rolled over in the next 12 months, and foreign buyers who used to buy 40% of new issuance are now net sellers. China has reduced Treasury holdings by $300 billion since 2020. Japan is selling to defend the yen. Saudi Arabia is diversifying away from dollars. Who's going to buy $7.5 trillion in new debt when the traditional buyers are walking away? U.S. commercial real estate is worth approximately $20 trillion. About $1.5 trillion in commercial real estate loans mature between 2024 and 2026. The problem? These loans were made when office buildings were 95% occupied and interest rates were 2 to 3%. Now offices are 50% occupied and rates are 7-8%. A 2023 study by the National Bureau of Economic Research found that 385 U.S. banks face potential insolvency if commercial real estate prices decline by 20%. They've already declined by 35% in major markets. So why haven't these banks failed yet? Because regulators are allowing them to not mark these loans to market value. They're carrying properties on their books at 2019 prices, even though everyone knows they're worth far less. Now look at what central banks are doing. The Fed's Bank Term Funding Program, created after Silicon Valley Bank collapsed, allows banks to borrow against securities at par value, face value, regardless of their market price. They're creating a mechanism to keep insolvent banks operating by letting them borrow against assets that have lost significant value. This is extend and pretend on a system-wide scale. 107 countries, representing 95% of global GDP, are now exploring or piloting central bank digital currencies. The Federal Reserve is testing a wholesale CBDC platform called FedNow. The European Central Bank is advancing the digital euro, despite public opposition. Their stated purpose is efficiency and financial inclusion. But look at the capabilities they are building in. Programmable money, the ability to set rules on how currency can be spent. Expiration dates, money that disappears if not used by a certain time. Geographic restrictions, money that only works in certain places. Negative interest rates, money that loses value if you save it. Why would you need these capabilities? Because when the next crisis hits, they need direct control over money to force economic behavior. In 2008, the Fed cut rates to zero and did quantitative easing. People and businesses still didn't spend. They saved because they were terrified. Next time, they don't want to rely on hope. They want to program money that you must spend in certain places by certain dates. They're building the infrastructure for direct monetary control. Global debt is now $37 trillion. That's 336% of global GDP. U.S. federal debt is $34 trillion and rising by $1 trillion every 100 days. Interest payments on U.S. debt are now $1.1 trillion per year, more than defense spending, more than Medicare. Here's the trap. At current interest rates, debt service consumes 18% of all federal tax revenue. If rates go to 6%, that number hits 30%. If rates go to 8%, debt service alone consumes 40% of all tax revenue. At that point, you're borrowing just to pay interest on previous borrowing. That's the mathematical definition of a debt-death spiral. So what can central banks do? Option 1, let rates rise naturally, watch governments default. Option 2, print money to buy government debt, watch currency collapse. There is no option 3. Look at what they're doing. Yield curve control. The Bank of Japan has been doing it for years. Now the Fed is preparing the infrastructure for it. Yield curve control means the central bank sets the interest rate on government bonds and prints whatever money is necessary to enforce that rate. It's a guaranteed way to control interest rates. It's also a guaranteed way to destroy currency value. They're preparing to choose currency devaluation over government default. The dollar has been the world's reserve currency since 1944. About 59% of global foreign exchange reserves are held in dollars. 85% of all foreign exchange transactions involve the dollar, but something is shifting. In 2023, 23% of China's cross-border transactions were settled in yuan, up from 0% in 2010. The BRICS nations are developing alternative payment systems. Saudi Arabia is now accepting yuan for oil sales. The Bank for International Settlements published a report in December 2023 titled The Future Monetary System. Buried on page 47 is this statement: central banks should prepare for scenarios where multiple reserve currencies operate simultaneously. Translation: they know dollar dominance is ending. When that happens, the U.S. loses its ability to print money and have other countries hold it. That $34 trillion debt becomes an immediate crisis because we can't just export inflation to the rest of the world. The infrastructure they're building, the swap lines, the digital currencies, the emergency lending facilities, it's all designed to maintain control during the transition from a unipolar monetary system to a multipolar one. So why won't they explain what they're preparing for? Because the moment they publicly acknowledge these risks, they trigger the very crisis they're trying to prevent. If the Fed publicly states, "We're concerned about Treasury market dysfunction," investors immediately sell Treasuries, which causes dysfunction. If they say, "Commercial real estate loans are impaired," depositors pull money from regional banks, causing bank runs. If they admit, "We're preparing for the end of dollar dominance," foreign central banks dump Treasuries immediately, crashing the dollar overnight. They're trapped by their own credibility. The system only functions as long as everyone believes it's stable. The moment they admit it's not, the game ends. This is why every crisis follows the same pattern. Everything is fine while building emergency infrastructure. Then, this is isolated and contained while coordinating international response. Finally, nobody could have seen this coming while activating the infrastructure they built. We are currently in phase 1. When this plays out, there will be clear winners and clear losers. Savers in dollars, euros, pounds, yen, anyone holding cash or bonds denominated in currencies that central banks will devalue to manage the debt crisis, you lose. Pension funds and retirees counting on fixed income, your purchasing power will be destroyed by inflation they'll call necessary. Middle-class employees whose wages always lag inflation, you will feel yourself getting poorer but won't understand why. Small banks and their depositors, they'll be allowed to fail to preserve the system. Just like 2008, major commercial banks who can borrow unlimited amounts from central banks, they'll get bailed out again. Those holding hard assets, real estate, commodities, productive businesses, things that hold value when currencies collapse, they win. People positioned in gold and other monetary metals before central banks admit the problem, they win. The ultra-wealthy who have access to assets and advice that help them navigate currency devaluation, they win. But here's what matters. You don't have to be ultra-wealthy to be on the winning side. You just have to understand what's coming before everyone else does. Central banks are preparing for something they won't explain because they can't explain it without causing it. But you don't need them to explain it. You can see it in their actions. They're building emergency lending facilities. They're buying gold at record pace. They're creating backup payment systems. They're rehearsing crisis scenarios. They're coordinating across borders in ways they haven't since 2008. All while telling you everything is fine. The question isn't whether a crisis is coming. The question is whether you'll be positioned on the winning side or the losing side when it does. History shows us one absolute truth. When central banks coordinate in secret while building emergency infrastructure, what follows is never good for the average person who trusts official narratives. Don't be that person. The time to prepare isn't when they finally admit what they've been planning for. It's now while they're still saying everything is fine. Because the moment they stop saying it's fine, it'll already be too late.